Annabel, thanks so much for your time as always. Right, so how worried should we be that this leading indicator is forecasting that we're not going to have better days in the next 6 months?
So look, certainly it's just 1 month's figure, but it is the first month's figure for the second quarter. And of course, we had a fairly good leading indicator for the first quarter, indicating at the end of this year economic growth should pick up. And of course, that's the expectation. Moody's themselves expect an upward trend this year for economic growth from our quite dismal contraction in the first quarter. But today's figure now points to the first quarter of next year. Arguably 1 month's figure, perhaps it'll improve. But what is worrying is if you look at the 3 months to April for industrial production, which is mining, manufacturing, electricity, February to April, that indicates 11.3% contraction on a quarter-on-quarter seasonally adjusted annualized basis. If that persists, then we'd be quite worried about GDP growth for the second quarter of this year.
So help us understand again, what is the reason why we're seeing contractions in such key areas for the economy?
Look, certainly from the leading indicator, we saw a deterioration mainly on the drop in the business confidence index, which we already have seen the data for in the second quarter, and indeed jobs advertisements again. So that was obviously a concern. Those are the predominant reasons for this moderation. In terms of, the pockets of weakness in the economy for the second quarter, again, just 1 month's figures, April, but obviously coming in tandem with those February and March figures, it gives you that drop down. I think that is partly reflective of what happened in the first quarter. If we move fully into the second quarter, we are expecting to see a rebound, and we are looking for economic growth stronger this year. But our forecast is now closer to 1.4, 1.5% from our previous forecast of closer to 1.8% for 2018.
So by expecting a rebound, are you saying that you're expecting sort of business confidence to improve in the quarters ahead? And if so, what will drive that improvement in business confidence?
So by a rebound, we're certainly looking at an improvement from the first quarter's GDP contraction of 2.2%. We expect we'll see a positive outcome for the second quarter GDP reading. Partly we expect to see some improvement on the agriculture side. We've certainly seen a good improvement looking ahead, certainly in the next few weeks, and what we've seen so far for agricultural crops and of course maize. The concern certainly is the mining, manufacturing, electricity. We'd hope to see an improvement in our second quarter as well. But looking forwards for business confidence, that would be the third quarter reading. We are hoping to see a lift because there is essentially about a 2-quarter lag between any change in business confidence and its impact on investment. So if we finally see an improvement in business confidence above the 50 neutral mark in Q3, for example, that really only heralds an improvement in fixed investment growth in the first quarter of next year, which in turn obviously means it impacts more the 2019 outcome. So, it does look like the data continues to be quite patchy, and that this year could actually prove to be a weak economic year.
I mean, in terms of mining specifically, we just recently had the draft mining charter, the third one that we had all been waiting for being released for public comment. Business has reacted to it, saying that, it's a little bit better, but it's still not the right kind of a document that will get us to invest. I mean, do you see a situation where, government and private sector can actually find a common ground on how to grow our much-needed mining sector?
Well, I think that's the key point. It's this lack of commonality which is really hindering us in South Africa. And of course, obviously not just South Africa, but foreign investors as well, looking at our mining sector, trying to price risk and reward, trying to see obviously where we're going with it. I think, the key issues really for us are a lot of focus from government, from the political parties, is very much on the 2019 elections. We're not expecting much momentum in the economy before then, even in terms of policy. Policy changes, but specifically policies which really promote economic growth, specifically that underpin economic growth. I think it's more about vote garnering at the moment. And of course, that's a cause for concern for the South African economy, because we continue to have very weak growth. And what happens if the figures continue to be poor for the second quarter? That means we do actually go into a recession, and our economic growth then could come out closer to maybe 0.7 for the year.
Jobs numbers were also released today. We increased jobs in the first quarter. This is a positive for South Africa, right?
And this 56,000 increase, it was quite a significant increase if you look at it alone. But 67,000 jobs were essentially created predominantly in the government sector. And that's both in civil service and, extended areas. So perhaps local government, key areas universities, technicon institutions, even areas that are extra budgetary items, such as social welfare. People work in the administrative office, those areas. 67,000 jobs essentially created in the civil service and extended civil service in the first quarter of this year. You drop yourself back down to 56,000 essentially by seeing the contraction that you've seen in some other areas such as mining and trade, etc.
I mean, what does that mean, the fact that all of these jobs are essentially being created in the government sectors? Does this point out to a ballooning public sector wage bill once again? And does it also come as a surprise, given that I recall when the president was elected, he said that one of the things that he would be looking to do was to right-size a government and really let go of some positions and departments there that were not necessary?
So I think certainly, the freeze on job hiring, so, not filling positions. And of course, this reading now for the first quarter the president really only came in mid-February. And of course, he probably had a few weeks to sort out many other issues. So probably the first quarter, he didn't manage to spend much time on looking at the jobs issue. I think we would maybe be fairer to judge him from the second quarter and see what is going on. I think the bottom line is, in the civil service, some jobs do need to be created in key priority areas, some people replaced, but in other areas perhaps a hard look needs to be taken. Of course, when you see a swelling in job creation, the civil service to this extent, particularly in the universities, the technicons, that really increased the cost base, again, which makes it even harder to provide affordable fees or free fees to students. So, everything actually ties back. Everything is connected. You can't just actually have a situation where something happens in isolation. You hope it doesn't have a damaging impact, for example, on government finances. And of course, that's what Moody's brings us back to when they issued their issuer note last night, talking about the state of our deterioration in business confidence from the first quarter and their worries about the lack of fixed investment. They said if this pulls through to an insufficient growth rate for this, it'll negatively impact our government finances. Of course, it harms the outlook for fiscal consolidation. Of course, our credit rating, we remain on investment grade from Moody's. That's the last of the three credit rating agencies who have us on investment grade. That would start to become at risk. And they've actually warned that they could give us a downgrade if we fail in terms of the economic growth and fiscal consolidation front. So we've yet to see the tide turn and fiscal consolidation actually come through. What we have seen is a lot of higher taxes, but we haven't actually seen a substantial cut in expenditure.
Of course, a downgrade would be a disaster for everyone here in South Africa. But
it's not our expectation, but it is a risk.
All right, okay.
We expect no credit rating downgrades this year.
That certainly brings comfort to my ears. But Annabel, thanks so much for your time as always. That was Annabel Bishop, who is the Chief Economist at Investec.